Hello and welcome to another episode of the Opus Well Style podcast. My name is Iván Watanabe here with my partner, Evan Wohl. Evan, what's going on, man? How are you?
Look at us in a couple of suits today.
I know.
A rare day.
Was it you who said, hey, you look like you're going to a funeral?
It's a joke, though. You look good.
I appreciate it, man. We every once in a while we gotta mix it up. So Today's that day.
Yeah.
It's good to see you.
I'm excited for, it's only like 5 days until baseball opening day, something like that. I don't know if I told you, I'm taking Parker to the Yankees home opener.
Let's go. Oh,
yeah,
good.
He is so spoiled when it comes to Yankee. He's already been to playoffs and the home opener.
It's unbelievable. I took Mia to a professional soccer game last weekend, and we were in one of the suites, and she was like, "This is boring. Can we go down and play on the field?" I'm like, "You don't understand." Like, it was like at one point it was legit snowing outside, and she's like, "I want to go sit outside on those," and I'm like, "No. The whole point is to sit in here, not over there."
It'll take her some while to learn that.
Yeah, 4-year-olds apparently don't understand that, but it is what it is. But listen, I'm excited about today's conversation. We're going to mix it up and do it a little bit differently than we normally do, right? Where we invite a guest on and kind of talk about one particular topic. I think today's podcast episode for the listening audience is going to be a little bit more kind of rapid fire, right? Mm-hmm. We wanted to put out quick answers and responses to questions that we're getting on a frequent basis from our clients, right? We thought that would be of value to you all listening. So hopefully as we kind of walk through these questions, I'm sure 1 or 2 or 3 or maybe all of them are questions that you have. So we wanted to kind of give some concise advice and of course, reach out if you have any additional questions, right?
Frequently asked questions. We're not going to dive deep on any one, but rapid fire. Here we go.
For sure. Awesome. So, as I said, I'm sure you're having the same exact conversation. Based on how the markets have been crushing it over the last few years, we're seeing in a number of new prospective clients come to our office, come to our meetings with massive gains in their investment portfolios, right? And so they're saying, hey, the advice I'm getting right now is to sell these at a gain, deal with the tax and kind of figure something else out. Now, of course, you got to consult with your CPA and tax professional, but what's the conversation that you're having with clients, and what are you saying to folks with big gains in their portfolios? This stays on the non-qualified side, meaning non-retirement accounts, and kind of how to address it.
Yeah. Fortunately, we're seeing a lot of it, like you said, and if you do nothing about it, that bill will only compound. When I say nothing, I mean just hold on, and you've got an unrealized gain because the positions shot up a lot, and now if or when you were to sell, you're going to have a big tax bill. And so what I see a lot of clients do by default is just nothing, and say, well, I don't want to incur a big tax bill, so let's just hold on to it. The problem with that is then it becomes a bigger and bigger portion of your portfolio, and the tax bill only grows with it over time. So one of the things that we're having conversations about is how can we not rip the Band-Aid off and sell it all at once and cause a big tax bill, but slowly and methodically build a tax transition plan to sell maybe a piece this year, a piece next year, and then maybe 3, 4, 5, 6 years, depending upon how big the positions are or how big the gains are, and build a more diversified portfolio around those gains. And so I think that's where the biggest conversations are for me.
Yeah, same. I mean, we're having the exact same conversation, trying to come up with sort of a tax budget, right? Really want to use some of the cash position that they have to be able to allocate towards it. And so what we've been doing is, for the listening audience, you can certainly look it up, but direct indexing strategies, right? To be able to map over the portfolio, use some of the positions that they currently have that the new recommended portfolio would use anyways, right? So we're just kind of moving over like positions. And then, also having conversations around using an interesting kind of, options or call and put strategy to kind of, especially if somebody thinks that the stock is going to continue to rise over time, right? So you don't want to necessarily liquidate it just to diversify away, especially if you think, the portfolio itself is going to perform well. So we're looking at sort of, a call and put strategy that's pretty readily available, direct indexing, coming up with a sort of a tax budget for all that transition, right? But I think first and foremost, really trying to say, what level of games do we have in here, and then how do we want to address this over time, right? I think the second part of this is also, we're talking about somebody coming to us with an existing problem that's only going to get worse. I also think that we are having these conversations earlier before it even becomes a problem, right? What are you doing with your portfolio? Hey, the world has been telling me to to put money into the S&P 500 for the last 20 years. Okay, well, if you continue to invest in that way, you're going to run into this problem, I guess, later on down the line, right? So having these conversations earlier with your monthly or annual contributions is probably important too.
Yeah, most of the conversations we're having is less about beating the market and more about being more tax efficient while riding the waves of the market.
That's right.
Whether that means reducing risk for a same assumed return, or putting in, like you said, with the collar strategy of just buying in some downside protection, but still staying invested.
Yep. And again, all this only matters if you want to use the money, right? If you don't want to use the money, you want to just pass this along to family. They get a step up in basis. That's great. So it's kind of at death. So it's kind of a moot point, right? But if you actually want to access the capital, then you need to be addressing these things, sooner than later. So
actually, maybe on that point, one more thing to add.
Yeah.
If, instead of selling positions at a gain and incurring the tax and then go do something with it, a lot of the conversations we're having also today is maybe you just open up a line of credit backed by the investments. So that way you leave the investments invested, don't touch it, and you're just using it as collateral and accessing the cash via line of credit. So another way to mitigate the tax impact.
Yeah, I mean, I think that's what you're seeing the ultra wealthy do, right? Elon is not necessarily selling off his Tesla stock, right? He's getting leverage against the position so that he can hold them and use the leverage to be able to, fund his lifestyle tax free, right? So, very, very common strategy in sort of the ultra high net worth space, but is available for lower level of assets. So, something to be aware of, but making sure that you're kind of building in a strategy to actually pay it back too. So, the second conversation that we're having often right now, especially around bonus time, is sort of the RSU conversation. So, what do you have in terms of dialogue with folks around that?
This is very common, especially for my clients in media, advertising, tech. I just got off a call with a client just 30 minutes ago about this. Part of compensation is very often stock-based compensation via RSUs, restricted stock units is what that stands for. And so that'll get granted to you, and there's typically a vesting schedule. Vesting just means when it vests, it becomes yours. Before it vests, if you were to leave the company, you don't have it. You have to give it back. And so when the day it vests, that becomes taxable income to you. What the default is for most people is they will have the system automatically sell some of the shares to cover the tax bill, and then they're left with the after-tax amount of those RSUs. A little side note that's important and a lot of people miss is the trading platform that you're accessing these shares on has no idea what your tax situation looks like. So they're just using a default for how much should they withhold for your taxes. And very often it is not the full amount that would need to be withheld. And so a lot of times next, April 15th, clients are getting a little surprised that they owe a little bit more money or sometimes a lot more money because not enough was withheld. So that's an important thing to keep in mind. You might just want to set some money aside for that or just be aware of it. And then the other thing to be aware of is you're compensated from this company, salary, maybe bonus, and now you've got the stock compensation. A lot of times what I'll see is too many people just, again, do nothing about it. And they say, all right, that'll be the money that I use for X, a home down payment, a vacation home, kids' college, whatever it is. But that becomes a very concentrated position and a big percentage of their overall assets when they're getting compensated from the company stock. And so a conversation that we're having very often is we need to make sure that on a regular basis, as these RSUs are vesting, we're going to sell at least some of them and start to diversify. Otherwise, all between your income, your bonus, everything is already based on this company. Let's not make your investments solely or too heavy focused on this company as well.
Yeah, I think the only thing I would add there is is the diversification. I think is critically important. But if you are, I sort of always defer to the client because they have the best pulse of how the company is going, right? As long as I think that they're realistic and have kind of clear intent and vision around it, my default is to ask them how they think the stock is going to do and like what's their perception of how the company is operating currently. Again, assuming they have the clarity around it, right? Because they understand the company better than I would, better than the analyst reports are going to kind of portray whatever is going on, right? So if they feel like, hey, listen, we think this thing is going to go gangbusters, again, there might be another strategy to kind of think about besides just, offloading the positions. But interesting, to kind of piece both those things together. But I get your point is a great one, which is don't just rely on the software to kind of run the tax analysis. You really have to kind of coordinate that with your advisor, CPA, to figure out like what is the actual tax number, so you're not surprised, come tax time.
Yeah, I always tell clients, take a screenshot of the gains and the realized gains that you're seeing, send it to your CPA, and just give them a heads up that we're going to need to take care of this.
For sure. One that I've been getting often these days, especially in kind of the physician marketplace, should I be doing the Roth or the traditional retirement plan? Right. I think my comment to all folks that are sort of weighing those options, one is, where do you think tax rates are going? Right. Do you think tax rates are lower today, or do you think tax rates are going to be lower in the future, right? Just generally speaking, what's their position on that? Do you think you're going to continue to make more money and increase your asset size over time, or keep the same or go down? And the other question that I really want to try to get people to the other part that I really try to get folks to understand is that the pre-tax 401k contribution is a deferral, not a tax elimination. Right? There's a big distinction between, hey, I'm going to not have to pay the tax today, but I will have to pay it in the future, versus paying the tax today and then having something grow tax-free, right? Principal and interest. And so that is kind of the conversation, and really, based on how somebody answers those questions. And obviously we have our own take on this, but that is how I set the stage to make the decision between those two.
Yeah.
How about you?
I totally agree. And the other point that I like to add is usually when we're having these conversations, well, first of all, the Roth 401k is much newer of a thing, right? It's only been around for 4 or so years, I think. The traditional 401k has been around since the 80s. And so 99% of the time when we're having this conversation, people have a fair amount of money already accumulated in pre-tax traditional 401ks and traditional IRAs. That will only continue to grow and compound going forward. And so it will be very helpful we don't just talk about diversification as it relates to investments, but you want diversification as it relates to taxes as well, so that you can get to retirement and have a tax-free bucket of money that you can pull from the Roth 401k or Roth IRA, so that you can mitigate or balance how much am I taking from the fully taxable distributions of the traditional IRA or traditional 401k. Maybe not take 100% of my income from there, because every dollar is taxable at ordinary income. Let's take some from a tax-free bucket. So it gives you more control around your tax exposure in retirement, which is when you're going to want it the most.
Yeah, and I have a new prospective client that we had a conversation last week, and it was really funny to see the level of disgust that they had around their pre-tax retirement plans, because they didn't need them for their retirement income. They are now retired. They're not quite yet 75 years old, and so they are petrified of the amount of taxes they're going to have to pay when required minimum distributions start getting pushed out from their retirement plans, because they are meeting their income needs through Social Security, through pension, through real estate investments that they've made, through non-qualified dividends. So they're meeting their obligations in retirement through all these other sources. So this retirement plan just continues to grow and build in the back. And like, again, people listening to this might think, well, that's a nice thing to have. I totally agree, but they are concerned about the tax implications that will get created based on those required minimum distributions. And they're trying to figure out like, hey, is there a way around this? And unfortunately, there's not, right? So just kind of, having that dialogue with them. It's very funny how at certain life stages things get perceived, and I find not all the time, but sometimes people kind of resent the fact that they have so much money in their quote unquote retirement plans.
If they don't yet, they will become more like that couple very often. And if you don't need it, there will be required minimum distributions. If it turns out that you're not spending it, like you don't spend it all in your life, then you're leaving it to your beneficiaries, your kids, spouses, whoever, and they receive it as inherited IRAs, and now they pay the tax on it. So that might mean they get bumped up on the tax bracket because they're forced. They're now forced to take the distributions on the IRA. They have to take it out within 10 years of being in receipt of the inherited IRA. So, not the best solution.
It is one of the worst assets to pass down from generation to generation. So, again, walking through that with folks, I think these days, how should we be putting money aside? I think we've given some good insight there. This is a big one, and probably regardless of income, I think this is often the question, which is, are we saving enough money? So how do you deal with that question when it pops up?
I like how you mentioned regardless of income, because most people assume people who are earning more money, sure, they save more money. Not always the case. Not always the case.
Yeah.
And so, in fact, I probably, maybe it's just anecdotal, but I feel like a lot of my clients that aren't earning as much, they just got used to a lower lifestyle. And so they're actually, on a percentage basis, they're probably saving more on a percentage basis. So as a general rule of thumb, I try to get clients to save at least 20% of gross income. And again, gross income before taxes, that would include any 401ks, meaning the contributions to your 401k would count as your as part of savings. So too would any cash value of life insurance contributions. And so you want, at a minimum, it would be great if you could save 20% of gross income. Cash flow changes from month to month, quarter to quarter, year to year. So there will be times where you're knocking it out of the park with savings, and there'll be times where you're running a deficit because you took the kids to Disneyland, and everybody knows how expensive that is. So what's important here is you can't just say we're saving enough, you're good. It's like, are you saving enough on a regular basis, month to month, year to year, et cetera? And so from that standpoint, you really do have to track it and keep on top of it. So we've got some proprietary tools that we use to help our clients with that, but it's just something that always needs to be revisited. Have we saved enough, looking in the rearview mirror the last 3 months, 6 months, year to date, and then make more informed decisions, spending decisions based upon that.
Yeah. And again, I think we've had conversations about this before, but really sort of flipping the conversation around savings on its head, where instead of it being how much do I earn, I spend X and then I save whatever is left over, right? If we can try to change the conversation and say, this is our target percentage of income that we want to save, income, save, and then spend whatever is left over, right? So if I have a client saving 20, 30, 40% of their income, I literally don't care what they spend the rest of the money on. They could light it on fire. It doesn't matter to me, right?
Yeah.
As long as we are saving systematically, right, the difference. And I think those types of behavioral changes really improve it. So, are we saving enough? I think it depends on savings rate. What target savings rate do you want to hit? And then kind of what systems do you have in place to make it reoccurring, right? And ongoing, right?
Yeah.
So that
the more you spend, the more you have to save, because now you're, like when we're talking about for retirement, now you need more money to replace your spending or your lifestyle habits.
Yeah, great point. What's the right amount of life insurance? So people get introduced to us, say, hey, listen, looking for some life insurance. We just had a kid. And when we have the conversation, I'll sort of explain the different types of life insurance, term insurance, UL, whole life insurance, IUL. We'll have a conversation about it all. And then I'll say, how much life insurance do you think you want? I'll say, well, I don't know. That's why I have you. Well, how much do I need? Okay. So when you're talking through that with folks, what's your conversation like?
So the first question I like to ask is, well, in an ideal world, what would you want the life insurance to do for you, for you and for your family? And when we get down, you probably like 2, 3 layers, questions deep, down to the fundamental part of it, most people will tell me they want the life insurance at a minimum to be able to maintain their family's lifestyle. So stay in the home if they so choose, allow the kids to continue to go to camp and all the kids' activities, summer vacations, save for college, retirement, etc. So at a minimum, there's kind of a range. At a minimum, you need to replace current expenses. So if you're spending 15 grand a month, times 12 is $180,000. That is the after-tax number that needs to be replaced. After-tax meaning you're going to grow your assets by some number per year, take off taxes, and that's what gets replaced for your family. So how much lump sum of a life insurance needs to come into your family if you're no longer able to work and earn an income for your family? So you're foregoing your future earnings, and instead your future earnings doesn't happen. You just receive, or your family receives, one lump sum. What is the minimum? And then on the high end is you just fully replace your income. So that's the two ranges: is what's needed to replace your living expenses on the low end, what's needed to replace your future earnings, because that's how the life insurance company thinks about what you qualify for. For example, if you have a house worth $1 million, the insurance company is not going to give you a $5 million insurance policy. People would be burning down their homes if that were the case. They're going to say, based upon your age and your income, what you're earning today times how many future years you're expected to work. That's kind of like it's a very simplified baseline of, all right, that's kind of what you would qualify for, how much you could possibly, the insurance company would offer you if you're medically approved. And then you decide what's right for you within that range.
Yeah, I mean, I'm explaining it the exact same way, and I think the other piece is, I am me, Iván, right? I want to try to make sure that if I get hit by a bus tomorrow, that my family's life doesn't change from an economic standpoint, right? It's the same as it was going to be as if I was here earning an income. I don't want my wife to have to make tough decisions on kind of a needs-based, do we need to keep this house? Do we need to do this? Do we need to do that? I just want her to be able to focus on, like, taking care of the kids and, hopefully maybe grieving.
Sure.
But honestly, I think that's my belief around it. But certainly, there are some folks that will sort of just process life insurance to focus on one particular base need. I just think over time, when we're buying insurance for that kind of lowest common denominator of need expense, oftentimes we find that ultimately it's not enough when something happens. So, I try to go more towards the want than the need on that. But again,
the other reason for that is because for most people, lifestyle does not go backwards, meaning like you spend more money over time for a whole variety of reasons. And so what may make sense if you think about it at a minimum today, 5 years from now probably doesn't make sense anymore.
Yeah.
And so that's why if you're kind of on the fence on one or the other, always go with a little bit more. You will never regret it in the future, and certainly your family wouldn't.
Yeah, and to a great point, like especially if you're buying term life insurance, right, and your expenses go up after 7 years, your term insurance death benefit's not increasing over that 7 years, right? So it's not adjusting with inflation to kind of keep up with either inflation or your lifestyle expense. So that absolutely makes sense. Another one I'm getting recently on the insurance, same insurance kind of guideline is the best time to buy disability insurance. Usually I'm getting that conversation, or I'm having that conversation with physicians, right? They're coming to me, hey, listen, maybe they're a fellow, and they're saying, hey, the attending, here's that, telling me I should get disability insurance. I'm hearing it's the right time to get insurance. My commentary to them is, best time to buy any type of insurance is the day before it happens, right? But since we don't know when that's going to be, today is going to be the best time because it's based on age and health, right? So if health is going to stay consistent, we know that we're going to get older, so the premiums are based off of those two things. So with us being younger today than we will be tomorrow, it's better to buy it today than it is tomorrow. Again, and then with the big variable of, am I going to be healthy kind of going forward, right? The other thing in the disability marketplace for those that are in residency and fellowship is there are significant discounts for residents and fellows. So the financial aspect of it besides just health and age and kind of the risk between applying today and applying in the future is that there are some significant discounts that you can't get while you are attending. But if you get it as a resident and fellow, actually can then go towards your attending policy when you do finish training. So that's really the conversation I've been having with folks lately around disability insurance, sooner better than later, and then making sure that they lock in those discounts.
Yeah. What I'm seeing is most people, if they work for a company, will have group benefits, group long-term disability benefit. That means, just very simply, if you become sick or injured and unable to work for an extended period of time, the disability benefit will pay you a monthly income until you're back to work, or until age, typically 65 or something like that. So two things to note here. Typically, that coverage is usually 60, sometimes 66, but usually 60% of salary up to a cap. It usually a cap of the monthly benefit, maybe $5,000 a month or $10,000 a month. Usually it does not include bonus or commissions. You'd have to look into the details of your plan for that. If that's the case, then there's probably a big gap between what you're currently earning now and how much you would take in if you become sick or injured. And so that's what you want to look into. If there's a big enough gap, then you might want to go out into the marketplace and look at how much can I fill and what that would cost. And then the other part is, especially if you were to leave your company and maybe be independent contractor or start your own thing, that is absolutely when you need to go out and protect your income, because you just lost all benefits. So now you're going from, earning X. If you get sick or injured, you're earning 0. And so the analogy I love here is, let's say you're earning $200,000 at a company, but if you become sick or injured, that goes to 0. That's option 1. Option 2 is you can earn, instead of 200, you earn 195. But if you become sick or injured, you're gonna earn 175 or 170, some number like that. Which of those two options makes sense for you? I always felt that framed it pretty well.
Yeah, that does frame it pretty well. I like that. All right, so let's move on. Another one I'm based on kind of the interest rates, right, and the Fed, staying steady, but rates in general, mortgage rates dropping for to the lowest point in I don't know, maybe 5 or 6 years. Is now the right time to buy or sell my home, and how much of a house can I buy? Are you having this conversation?
Weekly.
Frequently, yeah, right. It's like all the time.
So many people are choosing to not do anything because of interest rates. They don't want to upgrade or sell their initial home, even, sell their first home. They're just holding on to it and rent it out, and then go buy the second home because the mortgage rate is just so attractive. So it's certainly a big conversation that we're having.
Yeah. I mean, how much of a house can I buy? It really, for me, just goes back to the cash flow, right? So am I saving enough, right? Hey, I'm earning this. If I'm saving my X percentage and I want to buy that new house and I build it into that expense number and I can still save that percentage, by all means, it means you can afford that house. Oftentimes what I find is, somebody upgrades their home, but when we redo the cash flow based on the new mortgage and HOA or insurance and taxes, that number they were saving at 20%, now they're saving at 3%. I don't necessarily know if you can afford it, meaning I'm not going to default on the payments, but you can't afford it from a future state of I'm saving and doing the responsible thing while I own this house. You then become very house poor, as they say, right? So we want you to be able to enjoy your life, go on vacations, not have to feel like you're sacrificing on those things because you bought the home, unless, it is the end-all be-all goal for you, then that is kind of how I answer the how much of a house can I buy question. Are you similar boat?
How many times have you had that conversation? We come to an agreement. All right, $1 million seems like a good range, and they come back 3 weeks later. You know what, Evan? We found the perfect home. It's $1.3 million. It's like clockwork. And so there's two factors. There's the down payment, and then there's the monthly cash flow of the mortgage. And because interest rates are just higher than they were now 5-6 years ago, you can't buy as big of a home But yeah, and the other thing I like to remind people of, try to keep your your annual mortgage payment, so monthly mortgage payment times 12, below ideally like 15% of gross income. The lower the better. Because if it gets over 20%, let's say, that's when you're crowding out room for proper savings. And the only exception to that is if you are super confident that your income is going to rise over the next few years. Maybe that just means in the first year you feel a little anxious. You're not going on the trip. All the liquidity that you have is now in the home. Just know you're going into it, and then your income hopefully will rise faster than the mortgage payment. But that's a risk to take on.
Yeah, for sure. I mean, listen, because real estate, as we know, it's a very difficult asset to offload. Right. Not only do you have to find another buyer out there, then you guys have to agree on a significant purchase price, and that's the only way you could have two mortgages for a long period of time, or you could be stuck in a house that you're underwater on if you make the wrong purchase. So I think just being smart about it, making sure that it fits within your cash flow, having realistic expectations. If it's a house you're going to have for forever, I think I'm a little bit okay with buying going up on the budget just based on this is our forever home. If you're buying an investment property, those numbers have to work. You should be cash flowing positively immediately, right? I don't understand buying a property and then being underwater and carrying it for a long period of time. It just doesn't make sense to me unless the tax benefit for you is significantly more than the liability that you're paying, right? So that's the only time where it may work out. But another question similarly is kind of how much money do I need to retire? You get
the millions. $1 million question is not enough these days.
Yeah, it's funny because you go back to that Fidelity commercial where they had that kind of like green line and like, what's your number? I can't remember who did that. Maybe it was ING, something like that. But what's your number? And it's very funny to me how some people feel like they don't have enough. Some people feel like they have too much. It's just a really interesting dynamic when it's, for the most part, people coming to us with like a gut feeling, not necessarily anything verified in like economic principles or math, right?
So true. I think that has more to do with just like how they grew up with money. What's their money story? Yeah,
for sure. I mean, for us, again, we're running through cash flow analysis, just trying to predict. First, you have to get a hold of expenses, right? So what do we think life is going to cost during retirement? Make sure that you attach an inflation rate to that growth, right, of expenses, because you're not going to be spending the same amount of money today at that level for forever. That number needs to be increasing. And then figuring out, how much do they have in assets, have a realistic, conservative growth rate on those things, and then try to factor in some big lifestyle threats, right? What happens if the market goes down? What's that fluctuation look like? How are we dealing with sequence of returns risk? What does a health concern look like? How are we dealing with that particular health concern? What does that mean? I think once we do that analysis, we're very easily able to quantify whether or not, or verify, I should say, whether or not somebody can, conceptually retire or not safely. And it'd be fun. It's funny, depending on the level of expenses, like somebody could retire with $500,000 if they have a whole bunch of guaranteed source of income and their expenses are super low. And some people, $10 million is not enough. It just really comes down to what does it cost for you to live in retirement, right? That is the key. And then can we meet those obligations? I think, we're quite expert in.
And the closer you are to actual retirement, it's much easier to have this conversation and it be real and concrete. If you're 15, 20 years from retirement, life is going to change so many times between now and then. And so you can make those forward-looking projections on inflation and say, all right, this is what I'm spending now, increase it with 3% for inflation or whatever number you want to say. And then I start to hear people say, well, we're not going to have this expense or that expense. And it's like, yeah, you're going to have all these other new expenses that don't exist right now. You'll be paying for robots, I bet.
Yeah, no doubt. Absolutely.
Just like, just like we pay for cell phones that didn't exist 20 years ago, there's absolutely going to be other things that come up. And so that's why for people that are further from retirement, I don't like to rely too much on those forward-looking projections because it's all an assumption that will change over time. So that's why I want to stick to more fundamental principles of saving, saving appropriately 20% of gross income, having a good balance between traditional Roth or liquid and non-liquid. And then as you get closer, sure, you could run those analyses anytime and just have a sense of the track that you're on, which is certainly a good thing to do. But just know that life is going to change many times.
Yeah. I mean, the projections are wrong the second you press enter, right? I mean, life is just not going to work in that way, period, right? So it's just try to give you some general guidelines around it, but you need to be educated at least or verified in some form or fashion whether something's going to work out. So, and then lastly, listen, we are getting this all the time, and I'm getting sent Instagram videos on Trump accounts, 529 plans, like, what's the best way for us to save for education or for the future for our kids? And, where do you want to start there?
Well, there's a lot here. So we had a whole episode just on this topic alone. This was before Trump accounts were a thing, so maybe we need to update it. But was 3. Now we could throw in Trump accounts as the 4th, as the main ones. 529s really for college or higher education. UTMA, which stands for what does it stand for? I don't even know.
Unified Trust Managed Account.
There you go. It's an account for a minor is what that means.
Minor account.
Cash value of whole life insurance. So even though I have my own policy, each one of my 3 kids has their own cash value of whole life policy that I will change the ownership and gift to them at some point in the future, and that'll be a nice conversation. And now you have these Trump accounts. And just real briefly on the Trump accounts, they're still brand new. People are still learning about it and getting used to it. But basically, you could think about it just like an IRA for your child. So you can sign up now. I forget the website. We can put it in the notes. It's not active until July 4th of 2026. And I believe for any baby born after January 1st of 2026, I think, gets the free $1,000 just deposited into their accounts, then invested in a bunch of American equities. But then upon their 18th birthday, it just turns into an IRA with the same IRA rules. So each one of those accounts has their own pros and cons and nuances of why you might want to use one for one specific intention versus another. But those are generally the 4 most common these days.
Yeah. So that was kind of fun. That was a good rapid fire kind of questions that conversations we've been having. So hopefully to you, the listening audience, if you like that format, let us know. We're definitely going to take it into consideration to do another one just like it. But have anything else you want to add before we kind of wrap up?
This was great. In terms of feedback, not only let us know if you liked it, but send us some questions. We'll talk about some new ones. I had for the first time ever, I had a client asked me how come I haven't been on the podcast yet? he saw I did a podcast with a buddy of his that he introduced me to.
Love it.
So we're gonna have him on soon.
I absolutely love it. Well, listen, to you, the listening audience, thanks for tuning in. Please click subscribe below to be notified when we have our next episode. Hope you liked it.
See you soon.